Hey team, welcome back to another video lesson. It's Cody with One Purpose Trading. If you're just tuning in, we have 5 other videos so far. We started off with stock market avenues, brokerage accounts, trading styles, stocks versus options versus futures, cash versus margin, and limit versus market orders. If none of those make sense to you, or maybe some of those, and you might need a refresher, you can start video number 1 and work your way down. The goal of this course is to provide as much value and lay the foundation for getting involved with the stock market when there's tons of news out there and moving parts, and it can be very overwhelming. So leading into this video, it might be the most important area of the stock market. It is risk management and developing a trading plan. There is a wide variety of different trading styles and avenues that you can choose. So someone that is focused on long-term investing or long-term trading might have different parameters or a risk tolerance compared to someone that is day trading or scalping. So what we want to focus on today is laying the foundation and setting the tone for definitions of different areas you should focus on with risk management, and then giving you guys some real-time examples of how I personally use risk management in my daily trading style and how I've been able to be self-employed in this journey for over 3 years as we sit. So the first area we want to focus on with this, setting clear trading or investing goals. From that trading goal, that's going to determine where your risk is going to come into play. After you have a trading goal, whether that's day trading, a certain dollar amount per day, whether that's long-term investing, a certain dollar amount over the course of the next 10 years, whatever you are picking for that specific risk management plan, you have to make sure that it fits that avenue that you're focusing on. From there, you're going to understand risk tolerance. So are you looking for a very low risk, low reward type of trading style? Are you looking for something that's higher risk, high reward, that you're allocating a smaller amount of capital? Are you looking at something that's going to be a mix of the two? From there, you're going to determine the amount of capital that you're going to allocate to that specific trading goal or plan. After that, you're going to set risk limits. So you're going to establish risk parameters for each trade. Every time that I place a trade on a futures contract, I know the exact loss per trade that I could hit and the exact take profits, or a very rough estimate for the take profits that I'm aiming for. Also on top of this, you're going to start setting a parameter for how many trades that you want to take on a daily basis, a weekly basis, or an annual basis, depending on what avenue you're creating this for. After that, it's going to lead into choosing the right strategies, giving you that edge and the why behind each trade that you're placing. And of course, you definitely want to keep in mind that for every trade, you should have some sort of stop loss just in case the trade goes against you. In a perfect world, we are all 100% traders, meaning we never have a losing trade, but I want to be very frank with you. In this game, there are going to be losing trades and losing days. I don't care how good somebody on the internet claims to be, there will be losing trades and losing days for every single trader out there. Just an FYI, you'll hear a lot of traders on the internet say they have an 80 or 90 or even 95% win percentage strategy. That's cool and all, but if you're 5% or 10% are wiping clean the profits, that means nothing to me. And I've met tons of traders that have come over to my system that had a very high win percentage, but they didn't have a stop loss in place, so their losing trades would wipe clean all of their winning trades. So what I want to stress out of all this is you always want to put yourself in a position where you can lose more times than you win, meaning you lose more trades than you hit your profits on, and you are still profitable. Let me give you an example of that. Say every trade that you are placing, you are risking a total of $100 per trade. Your stop out of that $100 is going to be a $15 stop, meaning if you risk that $100, you're walking away with $85 at the lowest, meaning if it goes against you, the trade doesn't play out, you're not going to lose that full $100. You're willing to lose $15 if that should happen. Your take profit in this example is going to be $25. That means if you are right 50% of the time, you are a profitable trader. You do not have to be right 51, 55, or even 60% of the time. So what I try to stress and teach is put yourself in a position where you can be right only 35 or 40% of the time, and you're still breaking even or making money in the learning curve. It becomes game changer down the line. So what I want to do now is paint a picture of risk management on a long-term trading trading style and a short-term trading style. So if we look at this example right here, I have SPY pulled up. With my system that I use, I'm not going to go too much in depth right now. We'll look at this in a later video lesson where I go over my indicators, but essentially when we have the first green dot during the open market hours, that is where we would go long or go short or buy calls or buy puts or buy shares or sell shares, depending on what type of avenue we're looking at. So in this case, you can see this first red candle. That's where the first dot during the market hours are. You might say, there's dots over here to the left. Wouldn't we buy here? That's overnight trading or after hours or pre-market trading. I'm just showing you guys during the market hours when trading SPY. If we were looking at something like a futures contract, absolutely we could have placed a trade right here. So in this case, we would have bought in right here. So right at the candle, and we would have take profit set based off of where we entered off the candle. So this is all hypothetical in hindsight, but take profit 1 would have been here, take profit 2 would have been here, and the third take profit we hold all the way until the first red triangle. You can see there's no red triangle yet, meaning we would still be holding this last position. So this is where holding a running contract becomes very powerful in long-term investing or trading, and we'll jump into that again a little bit more in depth when I cover this strategy in full. But essentially what I like to do is always go in increments of 3. So 3, 6, 9, 12, 15 could be contracts, could be shares, could be whatever you're focused on. I like to buy increments of 3 so I can scale out of my position and I'm not stuck holding 100% and making that decision, do I want to sell all here or all here? I get to choose what percentage I want to sell. So in this case, I would have taken 33% off here, 33% off here, and the last 33%, it takes stress off of my shoulders because I already secured 66% of my holding and then a little bit extra of profit back into my account, and I can hold this remaining 33% of the initial investment for the long term, for the big push and momentum run of whatever I'm looking at. How does a risk management strategy apply to this? Well, if I'm entering 3 contracts, I need a reason to get out of my trades. I want to give myself some cushion so I don't sell out too early, but at the same time, I want to protect my account. So off of this exact same example, I would sell if this green dot would flip red, meaning the stock price would drop all the way down here and close. At that point, I'm out of the position. Out of all 3, 6, 9, 12, 15 contracts, however many I would be in, I am out of the trade at that point. What I did is I back tested this strategy, meaning I practiced this strategy over time. I back tested this all the way back until 2006 and saw the performance of it. I'm confident with the risk parameters that I have in place because I took a sample size of hundreds, if not thousands of trades, and I saw the average loss and the average take profits. Also on top of this, I saw the duration of the trades. So this might be a little high level, but this is designed for long-term investing or long-term trading. Now, if we're going to jump into my short-term trading style, I have something called a tick chart on the screen. This might be a lot of moving parts for you guys right now, so do not get overwhelmed. Let's start off with the red to green. So my candles are going to look different than anything that you are going to have up because they're coded. I was able to create my own indicators and reasoning behind those indicators of what I wanted to paint a picture for me. So in this case, when it goes red to green, that's step 1 in my trading style, and step 2 is going to be the first white arrow. This is going to be our entry point to the upside. If you remember the pricing on futures contracts, it's a tick by tick basis. So we're looking at NQ right now, which is $20 per point. So every point it goes in my direction, it is $20 profit. Every point it goes against me is a $20 loss. So you can see when this flipped, if I held through the duration of this trade until it flips red, this would be my exit. It would have moved 73 points in my direction, or $1,460 roughly. So in just over 40 minutes, $1,400, nearly $1,500 of profit was on the table to be made. Then coming into our next trade opportunity, if I scroll over to the right for you guys, the first pink arrow. So from green to red is step 1. Step 2 is going to be the first pink arrow. In this case, if we entered somewhere around there, even with slippage, we had the opportunity to make 107 points in our direction in about 18 minutes. So very, very powerful, very lucrative. It could also go against you. So how does risk management go into play to this exact system? Is I look back on thousands of trades now and saw if I would enter this trade what is my max drawdown that I want to give myself? The most that I want to put myself in a position where I'm willing to take that risk and it could easily go against me, but I want to give myself the edge in the market and confirmation to place the trade. So I went back and I did the hypothetical, what is the worst case scenario over the course of all these trades? If I go here and go here, and I saw with NQ that it's typically 15 to 25 points of risk. If I'm looking at something like MES or ES, it's typically 3.5 to 5 points. So every trade that I place, I have bracket orders, and from there it automatically plots a stop loss of 25 points or a stop loss of 3.5 points and take profits based off of my stop. So again, we're going to jump into a little bit more in depth of this when I go through my indicators and the system I use, but what I want you guys to take away from this is, depending on what avenue you are going to focus on, you must develop a risk management plan. This could be a dollar amount, this could be a point system, or it could be a mixture of both. What I tend to stress to my students is to focus on one specific avenue at first, whether that's day trading or swing trading or long-term investing. From there, come up with a dollar goal that you're aiming for over the course of X amount of time. So you pick the amount of time, maybe it could be a daily income of $30. Awesome. How do we get to that point and the correct risk to reward parameter? And from there, you build off of that. So I want to end it there for today, guys. I know it's a lot at once. Take your time to digest this video, write down notes. If you guys have any questions, you guys can always reach out to me on any of my socials at One Purpose Trading. I hope you guys have a great remainder of your day, and I'll see you guys in the next video.